Baby boomers better get out of the stock market. Oh my goodness. And this is written by my man Ron Surs. And I've been following Ron for a while. He's got those 1970s, whatever those things are, collars there. And he's got a 1970s look. He's just missing his mustache. I don't know who writes the headlines for Advisor Perspectives, but there's a headline. Baby boomers better get out of the stock market now. And I don't know if Ron writes it, if there's an editor. I don't know. The sad thing is Advisor Perspectives has been bought out. Perspectives bought out by probably a hedge fund or something like that. No longer allow comments or anything. And I don't know if they're clickbaiting. I just don't know. I don't know if maybe Ron wrote this headline. I don't know. But it's man, this is, I hate to say this, a dumb article. And I'm going to share with you why here. The gist is okay. But when the gist in terms of what he's trying to say is okay. But the headline that says baby boomers better get out of stocks now. We're just going to, I can't believe this. They used to allow comments. It just ticks me off they don't allow comments anymore. All right, so he talks about the history of stock market crashes provides confidence in staying the course and buying the dip because recovery is expected to be quick. But no one knows how long the next stock market crash will last and now how long it will take to recover from the crash. We do know that the past 15 years of rising stock prices is the longest bull market ever, and that stock prices are all-time highs. Oh my goodness, that drives me up the wall. They're basically always at all-time highs, Ron. They're at all-time highs in 1985. They're at all-time highs in 1995. They're at all-time highs in 2005. They're at all-time highs in 2015. They're all-time highs again. This whole thing, they're all-time highs. What compare? I can't take it. We also know that there's never been 78 million people in the retirement risk zone at the same time. These are the baby boomers. So I was like, well, what the hell is a retirement risk zone? Let's take a look. And we go here to peak financial planning, and I'm not sure who these guys are. Is that Chris Martinson's thing? Chris Martin, I like. Actually, I don't know. But so basically, retirement risk zone is right here. You're 10 years before retirement, 10 years after retirement. Oh, dude, that's a wide gauge of people. From 55 to 75, they're all in the retirement risk zone. So basically, a year from now, I'll be in the retirement risk zone. Oh my goodness, that's just being over the top. I mean, basically, from 25 to 55, you're not in the retirement risk zone. So your first 30 years of work, you're not in the retirement risk zone. But from 55 to 75, you are. That's just stupid. I mean, that's just too long just too long. Many years. 20 years? Come on, man. I mean, maybe I get 7 years or something like that, but 20? That's stupid. Anyway, and this ticks me off too. Cash flow plan. He's using right capital, which is fine. But check this out. Cash flow planning during the retirement risk zone. And I don't know who this guy is. I'm not bashing the guy. Maybe I am bashing. I'm just like, dude, for real. We got expenses right here. 111. Oh, let's just go right here. Expenses right here while the guy's working. 120. All right, he's got 120. Then the first year of retirement, his expenses go up by $17,000. Right, that seems weird to me, but whatever. I mean, doesn't that? It goes from 120 to 137. His total expenses go down because taxes are a big thing. But even that, total expenses, even that is 90% of his pre-retirement expense when you factor in taxes. I mean, it could happen, I grant you, but come on, man. His day-to-day expenses go up by a significant amount. I mean, that's that's 20,000. That's a 15% increase, basically. While his overall expenses are still 90% of his pre-retirement expenses, it just seemed weird to me. And also, I didn't understand here net flows. Net flow, this is from my capital, what I use for my software. How much are you pulling from your portfolio? Because you have 156 going out the door, but you only got 108 coming in. So 156 minus 108, that's $49,000 you need, right, to cover your expenses. Where's that $49,000 coming from while you're working? I don't get it, man. So you can see the net flows are always negative, and then we have a big net flow right here. So I don't understand that. So while we're working, our net flows are $50,000 a year. That doesn't make any sense. So anyway, whatever. I don't care. All right, let's keep going back to Ron here because I get this right here. Baby boomers cannot afford a bad crash, and he gives us a couple of instances. And where Ron's missing the boat here is it gets even worse than what he's showing. He says S&P recovery time for major. This is S&P now. S&P 500 recovery time for major crashes, nominal versus inflation adjusted. So we got right here. October 7th is when the market started to decline. It started coming back on March 10th of 2009, but you didn't get back to even Steven until March of 2013. When you factored in inflation, it was October 2013. So it took you 6 years to get back to even Steven. 6 years right there. What this does not include, it doesn't include withdrawing from your portfolio. If you were withdrawing from your portfolio at the same time, it's even worse, dude. And I'm surprised he didn't do that, because that right there, you got to avoid a major market crash when you're withdrawing from your portfolio. This is just saying you left your money as is. Well, if we go back to this guy right here, this guy is drawing from his portfolio because we got net flows. And those parentheses mean that money's got to come from someplace. It's coming from his portfolio. All right, so then we got the 2000, we talked about this right here, the 2007 to 2013. August of 2000 to May of 2007 is what it took to get back to even Steven for that, from that time, from 2000 to 2007, the aughts essentially. Interesting. So it took right here 6 years and 10 months. But if you factor in inflation, I don't buy this. It says it took 15 years. I don't buy that for 2 seconds flat, but whatever. We'll run with it. You're saying from August, and this is S&P 500, August, it took, with inflation, it took to February 2015. It took 15 years. Yeah, I'm not so sure I'm buying that when you factor in inflation. It took 6 years, well, basically 7 years without inflation, but it doubled with inflation? I don't think so. But anyway, be it as it may. December 72 to July 80. Again, it took, here we got, let's see, 7 years from bottom to top to get back to even. Time to recover, nominal. And if you factor inflation, it took an extra 7 years. I get that in 72 to 80 because the inflation is so high, but it still seems a little bit odd to me. If we're not drawing money from, if we're drawing money from the portfolio, that is devastating without question, because you're pulling money out while the portfolio is going down, and you're really going to have a hard time recovering from that. Now, here's the thing I got to say, dude. This right here freaking ticked me off. All right, so the fact that the stock market is currently at its highest price level ever does not portend well for even higher prices. Why? Why does it portend well for ever? Are the big seven in artificial intelligence stocks worth even more than their current price? Yeah, I think AI is not long for this world in terms of what people expect, because the cost of electricity are so through the roof how much electricity AI generates. AI is going to be its own electricity source. I literally have people tell me that. AI is going to be its own electricity source. Like, what? That's weird. Time will tell. Remember the dot-com bubble. But check this out. I was just looking at the Dow. He's looking from the Dow. From 1916 to 1982, the Dow had zero returns. This is just a Dow, not the S&P 500. From 1916 to 1932, the Dow had zero returns. What's wrong with that, amigos? What's wrong with that? From 1929 to 1959, the Dow had zero returns. From 1966 to 1995, the Dow had zero returns. What's wrong with these things here? Well, you can see right here, this is the Dow right here. 2,500, 5,000, 10,000, 15,000. So it looks like it's logged, which is good. But what's wrong with this? It doesn't include dividends. Just come on, Ron. Look at the S&P 500, and we're going to go back to what Ron was saying here, which is, what does he say, 1916? I'm not sure. Yeah, political calculations will go back. So we're going to go to political calculations, 1916. I'm not sure why we didn't use the Dow with the S&P 500, but whatever. We're trying to make a point. I guess we just use the Dow. 1916 to what he was saying was 1982. So we're going to go to January. Was it January? What month was it? Give us a month specifically. No, but 1982. Well, it looks like June 1982. So we're going to go to 1916 to June of 1982, and we're going to see what the S&P 500 did. And the Dow will have similar. It won't be the exact same, but it'll have similar. We're going to go calculate. All right, so from 1916, January 1916 we want June, actually 1962 right there. The S&P 500, again, this isn't the Dow, but there's going to be a lot of overlap here. Average 3.78% a year without dividends. All right, that's 9% a year with dividends. So almost triple the amount of. So, at least 2.5%. So if we're looking at this right here and we're not using dividends, that's just silly. It just really is. The inflation rate over that time was 3.4. So if you use no dividends, you're basically breaking even, like this chart shows us. If you're using dividends, though, you're averaging 5.4% a year with dividends. That's a real rate of return, 5.4% a year. But it's the S&P 500. Okay. It just, come on, man. This is, let's see. As you can see, the good times began in 1982, and the really good times have been the current roaring 2020s, which have begun much like the roaring 20s of 100 years ago that led to the Great Depression. Stock prices are all-time highs, drawing many in who fear of missing out, and there's a reason to fear a bubble burst. The odds are on a stock market crash because the stock market always crashes. A crash is long overdue. The Buffett indicator stands at an all-time 200% high, which is 2 standard deviations above trend. Some attribute the buoyancy of the stock market to the ongoing $4 trillion per year in retirement plans. Contributions persist regardless of market values, and much of these new monies are flowing into passive stock index funds. The retirement plan faucet doesn't care about market values. $4 trillion is 7% of the $56 trillion total stock market value, which is enough to matter. All right, so anyway, I just baby boomers, protect yourself. Younger people have time to recover. The baby boomers don't. While Professor Jerry Siegel's Stocks the Long Run is a very popular book, it is preordained that stocks always win if you wait long enough, but babies do not have the luxury of waiting very long. I completely get the sentiment, and I get the gist of it, but the idea that baby boomers get out of stocks now because a crash is coming, because they're all-time highs. We see some evidence that a crash happened before, not a crash, but a longevity from 1916 to whatever it was, 82, the Dow didn't do anything. Well, yeah, if you're not including div, I mean, why not? I mean, Ron's got to know this. I don't understand, like, why are these guys not doing? Then it's just weird. I don't get it. Like, what are we doing? Just tell the truth. How do you not use dividends? How do you just use price? When we know how much dividends were impacted returns, how do you not use that? Anyway, we'll love your thoughts. God bless. We'll see you.